Well, good afternoon. It's Thursday, October 3rd. Welcome to our quarterly chart party. We've got a lot to cover today, so I'm going to get right into it. First and foremost, I always like to remind people the three things to do for our clients. We want to be their go-to advisor, optimize their wealth, deliver service with integrity. Today's really about being your go-to advisor. It's about educating our clients. So we've got a whole host of things to cover today. If you have questions, I'm going to save them all to the end. But as a quick reminder, service at o'harewealth.com or text 414-644-0060 and I'll take them all in the closing statements. So what am I talking about today? Well, there's a lot going on. So first and foremost, the Fed cut rates. What does that mean? Why do they do it? Secondarily, what's in store for the market? What's in store for the economy going forward? And lastly, how does the election, which is just a little over a month away, how does that change our investment outlook? So let's start first and foremost with the Fed. The Fed has a dual mandate. They want low, stable price inflation, and they want low unemployment. So let's talk about each of those things. First and foremost, to go back to 2021, we didn't have an inflation issue, right? Inflation was 1.4%. And the Fed didn't respond very quickly. And they didn't respond very quickly because most of the inflation was seen in core goods. Remember, we couldn't get things off of ships. And energy costs. But in March of 22, they told us, hey, we might have to do a couple of rate raises. We might even be a little over 1% by the end of the year. Well, inflation peaked at 9.1% in June of 22, and the Fed raised rates faster than we'd ever seen. So why did the Fed do that? They did that to beat inflation. They didn't want inflation to get out of control. And as a result, inflation has come down, right? Inflation right now, CPI is estimated to be 2.9% this year on average. If you look at this chart, shelter has finally turned. So it kept inflating, but it has turned down. Dining has turned down. Actually, core goods and energy now are actually deflationary pressures. So this is ultimately good news. But that doesn't tell the whole story. As many people have pointed out, well, prices are up 23% over the last 5 years. Yes, they are. That's the total amount of increase. The good news about that is, yes, prices are up 23% over that time period, but as an American people, our personal incomes are up actually 35%, and our total net worth as consumers is up, I believe it's 47% or $50 trillion over the last 5 years. It's estimated to be up 11% just this year. So with that in consideration, yes, the prices of everything have gone up, but consumers are basically net ahead on this trade. Now, one of the things that is important about inflation is because inflation's been coming down, when the Fed raised rates to 5.25, one of the key things was at the time, inflation was over that amount. So the nominal rate, or the rate the Fed publishes, minus inflation, is what we call the real rate. The real rates were still negative when they stopped raising. What's happened since then is inflation's come down, making the real rate greater. So again, we were at 5.25 and inflation was just under 3. Well, the real rate was the difference between those two. So the real rate had actually become restrictive, and that's part of the reason it gave room for the Fed to cut at all, much less 50 basis points, is because even without changing the rate the Fed listed, it was actually becoming more restrictive and doing more of the work that they wanted it to do. But then that goes to the second mandate, unemployment. Why would the Fed cut rates? Part of it is because of unemployment. They want to make sure that unemployment doesn't get out of control. And what we were afraid of early on was 70s style stagflation and a wage push inflation cycle that's very, very difficult to end. And why were we afraid of that? Well, because we were seeing 7% annual wage increases at one point in 2022. But if you look at this chart, there's two lines you need to pay attention to. The gray line is unemployment. The blue line is actually the wage increases. If you look at the gray line and the blue line, they move almost in opposite directions for the most part. And why is that? Well, when unemployment's high and everybody's looking for a job, raises don't get handed out that easily. The flip side is when everybody seems to be getting a job, raises are plentiful because people are getting poached. Where are we at today? We're at 4.2% unemployment as per August. The natural rate of unemployment is 5%. The average rate of unemployment is 6%, a little over 6%. But when you look at this chart, what does it say? We had unemployment in the threes for a long time. So you'd expect massive wage growth. Well, that's starting to go away. We're starting to get more moderate wage increases of closer to 4%. If that's the case, it means that again, the Fed has won the war on inflation, but they want to make sure they can cut rates and help support the economy so that we don't have a spike in unemployment and go quickly from 4% to 5 or 6 or 7. And we don't see that happening partially because there are still a lot of job openings, but there's people looking for work. It used to be just a few months ago that there were some crazy number. I think it was like 12 job openings for every person looking for work. Today, it's basically one for one. So the overall unemployment index and the overall labor market is actually very well balanced, and that's what the Fed wants to make sure that doesn't get back out of balance. And that was one of the key reasons they were able to cut 50 basis point. But now that they're cutting, which is a big change, because we were talking about holding, we were talking about raising, now we're talking about cutting. Where are they going to go next? So this is a chart of Fed rates. What have they been basically since 1993? If you look here, there's also recently there's some predictors going forward. There's green, blue, and purple. Green line is what the market expects. The blue line is what the Fed has announced they plan to do, and the purple is where the Fed wants to get to ultimately. Well, good news is we're pretty much in line. There's not a huge warping between the two, but that's the market expects the Fed to cut a little bit faster than the Fed is planning to, but ultimately both of them kind of agree that we're going to stop close to 2.9%. Or probably between 2.75 and 3% Fed funds rate. If that's the case, it means that we're ultimately we're not going to replicate the 0% rates we saw for basically the whole decade prior. We spent a whole decade basically zero rates begging for inflation. Now inflation is going away, but we're probably not going to send rates back down to zero. So why is this important? Well, are they going to engineer a soft landing or not? That is the key question. If they're engineering a soft landing, if we're actually in that process, there have only been 3 soft landings, right? 1966, 1986, 1996. The good news is we get to look at 1996 on this chart. Hopefully it's not 2026, 2025, but what happens is the Fed raised rates, right? They tried to engineer a soft landing. They lowered rates a little bit, but they didn't come down to the previous low levels. And they actually plateaued, went sideways, and actually 12 months later, they were raising rates slightly again. And I want you to keep this in mind as I talk about some other pieces, that 2.9%, that's probably where the Fed's going to start to slow down or stop. Whether it's 275, 325, or 3% exactly is less of important as the fact that it's not going to go back down to zero. And if the Fed is engineering a soft landing, things should be pretty good. We don't see recession on the horizon for a couple of reasons. One, unemployment looks pretty good. The consumer ultimately looks pretty good. They still have record low debt levels. And we don't have things like an energy spike or an overly aggressive Fed. We've got a Fed that's currently easing. Yeah, energy's gone up a little bit in the past couple of days, but still, I think it's like $73 a barrel today. It's not 100 or 150, 200. It's it's $3.25 gas. That's what we're looking at going forward. But when we have seen the Fed change and lower rates, basically, if you throw out 1973 and 2008, which were horrific recessions, right? 2008 being the Great Financial Crisis, 1973 being basically the only other worst recession since the Great Depression. If you throw those two out being horrible economic collapses, other than that, recession or not, the market has returned about 13%, according to our friends at Invesco. If that's the case, it means that things actually look pretty good for the market because they're going to lower rates here. But this soft landing, it's not going to be a march back down to zero. It's going to look a lot more probably like that 90s rally where you're going to go down a little bit, go sideways for a while. Keeping in mind what rates are and what we're expecting rates to do, let's talk about yields and rate curves. So what is a yield or yield chart or a yield curve? It's how much interest would the U.S. Treasury charge for the period in which you're going to lend the money. August of 2020, if you wanted to lend the money for 30 years, you got a little over 1%. Doesn't sound great. If you wanted to lend the U.S. Treasury money for 2 years, you got basically nothing. But that's a normal yield curve. You expect that the rate would increase the longer out you go. What happened in July of 2023? Remember, July of 2023, you got to put yourself back there for a second. At the start of that year, we expected a huge recession. 90% of Fortune 500 companies said we were going to see a massive recession in Q3. We didn't think that was the case, and ultimately the market actually grew by a little over 4%, or not the market, the GDP grew by a little over 4%. But during that time, we had peak inversion. What is the inversion? It's the difference between the 10-year rate and the 2-year rate. 2-year rate was almost 5, 10-year rate was under 4. So think about that logically. Why would you lend less money or get a less percentage rate to lend for a longer period? The answer is locking in at 3.8% back in that July seemed pretty good if you expected that when that 2-year note was up, that you'd probably have to renew at a much lower rate. And ultimately, although 3.8% was lower than 5, over the entire 10-year period, you're actually going to be better off. And of course, today, we're at like 3.6 on the 2-year. So that part of that thought process has come to fruition. Just a quarter later, October 19th, almost a year ago now, it was basically the bottom of the market, the stock market, but also it was the peak treasury rates. We actually thought that the economy was going to take off, keep accelerating, keep growing, and we'd have to keep raising rates, and long rates would actually continue up. We'd uninvert the curve because of the look forward, because we'd be so much stronger going forward. At that time, treasury rates were 5% on the 10-year. But what's happened since then over the last year? Right? Let's take a look at that. That's the blue line, or the dark blue line. The 10-year is 3.8. It's actually like 376 or something like that today. Obviously, it moves while I'm talking, but it's pretty close to that number. And the 2-year is 3.6. The yield curve is uninverted. The 2-year is now less than the 10. Right? That's a very important marker. Again, usually the Fed lowers rates for the first time, and when the yield curve uninverts for the first time, typically that is the start of the economic slowing cycle. And I want to point that out because it's very important. It means that the economic cycle, as you think has started, is just starting. What does it mean for rates? Well, if you think, well, we know rates are going down, the Fed's going to lower rates, good time to buy long bonds. We do have a little bit of a problem with that. If you were going to take this section here, right, where are short rates today? Because the Fed controls short rates, the market controls the long rates. What would you expect this to look like if the Fed has their druthers in a year or so and we're close to 2.9%? And by the way, remember, as I said before, it wouldn't be unlikely to see a raise again from a lower level in 18, 24 months. I mean, it's very hard to predict out that far exactly what that group of humans is going to decide. But if they did get back to 2.9%, well, what would this curve look like? You'd see 2.9% on the 3-month, probably what, 3.31 on the 1-year, 3.2, 3.7, 3.6 on the 5-year. 3.7 on the 5-year, and then probably like 3.8, 3.9 on the 10-year. Well, if you're looking at this chart, we're already there. Probably most of the change was from that 5 to 3.8%. And as a matter of fact, if the economy starts to grow back out of that, you'd expect a steepening yield curve, meaning that the difference between the 2-year and the 10-year would get greater. And if that happens, well, then the 10-year goes back up, and that doesn't help your bond prices. If you buy them today at the 3.8%. So why are we talking about this yield curve? Is maybe the big move in rates might be over. We're not going to go back down to zero. We're not going to get to make up all the money that was sort of lost through the rate changes going from 0 to 5. But we're probably not going to be able to wait either. So for us, the short end of the curve is where we're going to see probably the most number of changes in the next 12 months. Talking about GDP, current estimates for GDP are that we're going to grow 2.5% real GDP this year. And next year, we're estimated to grow at 1.8%. 1.8%, if you didn't notice, is less than 2.4%. That is slower growth. Doesn't mean negative growth. It means slower growth. So when I said that it started, that's the difference between 2.5 to 1.8. Remember, last year this time, we were growing just over 4. And actually, the reason I brought this chart is this is revised GDP. The Fed goes back and revises GDP constantly. I don't know how far back they can stretch, but it's years and years and years and years. It might even be decades they can stretch back and keep revising GDP as they get new data. But for the most part, they essentially revised all of the GDP numbers up things were not only good, things were better than you remembered. As a matter of fact, things were not only better than you remembered. Remember the 2 negative quarters everybody complained about in 2022? Turns out we only had 1 negative quarter. That blue bar there is the revision. Well, only one of them was negative. So things were not only good, things were better than we remember. So from that standpoint, yes, things are better. Are we going to grow at 1.8% next year? That's anybody's guess. That's the current prediction. But that is definitely slower than 2.5. It's certainly slower than Q1 2021. We're growing over 6. I mean, that's why the yield curve was inverted. It was expecting slower growth in the future. Yes, of course you expect slower growth in the future if you're growing at 6% or 4%. The economy is built to grow at 2.5%, right? And slowing down to 1.8 is not really that much slowing. It's still bad for economic. It's not going to be as much fun as it was when we were growing at 4, but ultimately 1.8 is more reasonable. And this is what an engineered soft landing would look like. Consumer confidence. So talking about the Fed, one of the key points about consumer confidence, we're 2.5% GDP. In the last 50 years, basically since we've been measuring consumer confidence, we did have one all-time low spike, and that was June of 22. That also turned out to be peak inflation at 9.1%. Remember, we're nowhere near that today. People were more upset and more despondent about the future of the market and the economy that month than at any other time in the last 50 years. Think about all the other things that have happened in the last 50 years. There's been a lot. There's been a lot of bad things. People were more despondent 2 years ago, right? But why are we confident looking forward? Well, it's not like everybody's thrilled today. If you look at the recent number in September, we're still well below the averages. And when do recessions catch people off guard? They catch people off guard when everybody's overexcited and everybody's a little over leveraged and a little overconfident. That's not what's happening right now. People are still generally upset. People are still generally not feeling good. Why is that good for the market? Well, if you look, when the old adage, buy when there's blood in the streets, when things are horrible and people feel horrible, you tend to make excise returns. The last 9 times we've seen this, you're up 24% a year later. The flip side is when everybody's confident and excited, famously the previous peak was January 2000. What was coming next? The tech bubble bursting. When you hit those peaks, the market tends not to do well for the next 12 months. Now, it's not a perfect rule, but it does give us some leeway in the idea that perhaps we're not going to have a horrific, we're not set up for a horrific correction because we're not overly excited. Everybody planned for a recession last year. That's why the market was so rough. Remember, we were supposed to have one in Q3 last year. So I don't think people are over leveraged. I don't think they've overhired. I don't think they've overbuilt. And I don't think they've gone out of their way to do something crazy. But, the 11%, before I talked about the U.S. consumer, the U.S. consumer is $163 trillion. It is on pace to grow by 11% in net worth in 2024. We should actually feel good about things, but ultimately, we still don't from a sentiment standpoint. Briefly, I'm going to give people a second. Megan, do you want to cover that? The call-in?
Yeah, of course. Just a reminder, folks, we want to hear your questions. We have a couple of ways for you to submit those. You can email them to us at service@o'harewealth.com, or you can also text them to us on our main line. That's 414-644-0060. So I know we have a couple in the queue already. We are going to save those to the end and address those as time allows. So we want to hear your questions. Go ahead and submit those as they come up.
All right, fantastic. So let's talk about the market and the economy. All-time highs. This is an old chart. We don't have an updated version of it, but we've hit 43 all-time highs on the S&P 500 so far this year. And when we started this year in our launching outlook, we said we were expecting between 50 and 60 all-time highs to be hit this year. Now we got 3 months to go. We're at 43. If it's 49 or 61, we got the direction right, which is frankly most of what we're looking to try to do is get the direction right. We're pretty darn close. Why did we think that? Well, because new highs tend to cluster together. If you look at the 90s, if you kept hitting new highs, you kept seeing things get better and better and better. The 2000s, we were in a secular bear market, which is a 10-year sideways trend. Occasionally we hit new highs, but it didn't work out very well. But then we were in a secular bull market again, starting 2012. We hit new highs, we kept hitting new highs, and things kept getting even better. We just went through the longest bear market since the great financial crisis, It took 2 years. If you look there at 2022, there's one new high. That was the first trading day, and then we never saw it again. So we spent all of 22, all of 2023, and then starting out this year, like the first month under a new all-time high. And then as soon as we hit one, we said, no, this is going to be good. We're going to keep hitting more of them. Why are we excited about new all-time highs? Because everybody knows buy low, sell high. Well, from 1998 to 2023, if you were to buy on any given day in the market, 3 years later, on average, you're up 40%. If you were to buy on all-time highs during that period, 3 years later, on average, you're up 48.1%. Maybe the adage should really be buy high and sell higher. But the S&P hit a new high. The Dow recently hit a new high. The NASDAQ is a little bit off of its old highs, but the S&P equal weight has just hit a new all-time high. And why is this important? The S&P 500, as we talked about before, and as I'm going to talk about again today, is overweighted in a few names, and some of those are NASDAQ names. The equal weight is an equal sliver. So instead of by the size of all the companies combined, adding them all up together, you take an equal sliver amount and put it in. The fact that that's hitting new all-time highs is arguably more important. It means that the strengthening of this rally is more broadened when the equal weight hits new highs. Speaking of the S&P 500, what key points do I want to talk about here? We're still in a secular bull market. As a matter of fact, not only are we in a secular bull market, if you look at this chart closely, from 2000 to 2012, the market went sideways. We made no ground. That was the lost decade. We've heard that many, many times. From 2012 to today, we've been in a secular bull market. If you look at this chart and you were to keep drawing the line from 08 to COVID, you'd actually say maybe we're a little bit ahead of where we'd expect to be. And yeah, the market could probably suffer a 20% decline and still be in a secular bull market. That's how strong this market has been. And that was one of the reasons we thought the market was going to come back very, very strongly in the last couple of years, because we are in a secular bull market. You tend to have long time periods where things go correct for 10, 20 years. We're in one of those periods. But the market might be a little bit overheated. And why would we say that? Well, because the price to earnings ratio is 21 times. What is a price to earnings ratio? Really quick, for those of you who don't know, the historic average is about 16.5 times. And what it means is that I'm willing, on average, to pay $16.5 to earn $1 of earnings. And I'm hoping that underlying dollar grows as the company gets better at what they're doing. But I'd like to get all my money back in about a little less than 16.5 years and then grow from there. Then be on the gravy train. That's the price to earnings ratio. Well, in the 2000s, everybody remembers we were pricing to eyeballs. We had exceptionally inflated PE ratios. Well, the NASDAQ's lucky it's not on this chart, because it'd be off this chart for the PE ratios. And the market spent 2 years in the shortest, shallowest U.S. recession in U.S. history, repricing price to earnings. That's why the market fell 50% during that period. It was repricing its PE ratios. In 2008, we had low PE ratios, but we also had an economy that was absolutely falling apart. Today, we're a little bit over that. We're at 21.55 times. But I want to preface this. This is a little bit different this time. And I hate the phrase it's different this time, but there are things to factor in that we haven't done in the past. It's the makeup of the S&P 500 is relatively different than it has been over the same period. I'm going to ask people to remember a lot of stuff today, and this is one of those slides. This is a short and simple one. Profits, right, follow the index. Between S&P 500 earnings and the S&P index, there is a 0.97% correlation. One would be perfectly correlated. Negative one would be perfectly oppositely correlated. Near perfect correlation between making money and prices improving. Why is that important? Well, because long term, it means that there is some inflection, right? We can get overly excited or overly pessimistic, but in the long run, you'd expect that earnings and prices are highly correlated, basically perfectly correlated. If you make more money, you'd expect to be worth more. This doesn't seem like strange math, but I want to keep that in mind, because I'll reference the slide a couple more times. I'm going to very quickly talk about a few charts here. First and foremost, the makeup of the S&P 500. Why did I say that's a little bit different? I said it because of this chart. Today, the top 10 stocks are 36% of the market. Right? In 2000, they were 26% of the market. We thought there some big companies driving the market then. We're 36. We were 38 earlier this year. 38% of the market is just 10 names. It's the S&P 500, not the S&P 10. So the fact that it's the S&P 500 is a big deal. Why is this an issue? It's an issue for a number of reasons. NASDAQ actually talked about this 2 years ago, maybe changing the way in which we measure the index because of the overconcentration risk. Standard & Poor's, as well as the Russell, in early September, made a statement that they are going to possibly consider changing the way in which they measure indexes because of this issue. The SEC and the IRS have told people they need to start changing the way in which they measure these things because of the overconcentration risk. And it's well known now the SEC and the IRS are planning to crack down on several mutual funds and even maybe some ETFs for essentially only holding a couple of names when they claim to be well diversified because they're so overly concentrated. I can tell you right now, today, from a compliance standpoint, if I was to buy the S&P 500 in somebody's portfolio, I'd probably get a call from compliance tomorrow that I'd be violating mutual fund rules for not being properly diversified. That's how concentrated the index has been. This isn't just us saying it now. It's a regulatory issue now. But why is that different? Well, because we're not usually that concentrated, so we need to look at the different parts. So let's look at the top 10 versus the rest. The top 10, right? Of course, going back to the 2000s, the top 10 were very, very high in terms of the price to earnings ratio. But today, even, they're 30 times earnings. Remember, the market's historic is 16.5. Now, the top 10 stocks usually are great performers, right? ExxonMobil, when it became the largest company in the world in 2007, was a great performer. Now it's grown 50% since then. The rest of the market's quadrupled, but it was, if you've been a great company for a long time, you kind of deserve a higher PE. You've done a very good job. It makes sense that people will be more excited and pay more for your earnings. But if you look at this as a separator, the remaining stocks are trading about 18 times. And historically, they trade for close to 16. Yes, they're slightly overvalued from a long-term PE ratio standpoint, but not nearly as much as the top 10 specifically are. Right? And of course, why has that been happening? Again, it's all driven by earnings. So one of the things that has happened recently, and you can see this chart here, earnings, the new contributors to earnings have been the top 10 stocks. They're now 26% of the earnings. Now, of course, if you've been listening, what are you thinking right now? They make 20% of all the profits of the S&P 500, but they're worth 36% of the S&P 500. I thought you said they were perfectly correlated. That is our biggest concern. If they are perfectly correlated, there's really only, in our opinion, two ways for this to end. One, either these profits continue to rise and come up, or these stocks go back down to meet their PEs. And what you'd probably see is you'd see the rest of the stock market continue to grow. And why would you see the rest of the stock market continue to grow over the same period? Because of earnings. This is a chart of earnings. Where did earnings come from? Q3 of 2023, there's one stock everybody has been talking to me about recently. Why did it take off? Because 70% of all of the S&P 500 earnings, over all 500 companies, 70% of the growth came from one stock. And the other 30% basically came from another 6 of them. Of course, they've been rockets, right? But what do we do looking forward? Well, the yellow area there is the rest. We'd expect profits to grow from everywhere else. Right now, profits estimates for next year is a 16.7% growth rate. Right? That's what we'd expect profits to increase by. But that's going to be brought on by the rest of the companies, the other 493 companies that have not seen nearly as much growth in their profits lately. We're expecting them to be the major contributors next year. Right? So with that, we'd expect there to be changes, and we'd expect that 36%, not necessarily for these companies to shrink, but more importantly, that all the other smaller companies are catching up to the rally. And possibly there's a little bit of a combination of both. But it's one of those things we're keeping a very, very close eye on. One of the questions I do get about this, though, is, okay, that's great, but you don't understand AI and how powerful it is. I want to remind people, although the AI story is new, we've gotten hyped up about these sorts of things before. Whether it's the internet, the cell phones back in the 80s, whether it's pot stocks a few years ago, whether it's 3D printers in the late 2000s, everybody tells me they're going to solve all of our problems in 2 years. And there is an adage out there that we overestimate how far we'll be in 2 years and underestimate how far we'll be in 10. If you read our last book, Frostbite, people were initially afraid of refrigerators. Now we all have them. What does this mean? If you look at this chart, we get excited about a technology. It's going to fix all of our issues, right? McDonald's put together a program to have IBM's Watson, their AI software, create a menu ordering system. So when you drive up, you can talk to them. I think everybody here has been to a McDonald's. You drive through and you yell 6 or 4. I need a number 2. The program was so unsuccessful, they ended the trial. This is AI in action. It wasn't working. And the trough of disillusionment is when we say things like, oh, all we're going to do is, write term papers and make stupid pictures with AI. Well, the internet is one of these examples. It was going to fix all of our problems in the 90s. And in Priceline at the peak, they said everyone one day will purchase all their tickets online. Their plane tickets online. They were right. But if you bought their stock at the peak, it took you 17 years to start making money again. You broke even while the rest of the market quadrupled. Why is that important? Because that trough of disillusionment, that plateau of productivity, that's when it becomes an everyday use. In the 80s, we were all going to have cell phones by 1990. Well, that didn't really happen. That took a lot longer to get there. But now it's part of our everyday use. 3D printers, they were going to revolutionize manufacturing. Every manufacturing facility would have huge numbers of 3D printers by the middle of 2015. No, that's not what happened, but they are definitely incorporated more into manufacturing today, and we see them used in all sorts of new and unique ways. That's the plateau of productivity. So, the last question that I was going to talk about is the election. Great news. This is the most important election of my lifetime. It's actually been great because, as far as I can recall, every election I've ever sat through has been the most important election of my lifetime. As a matter of fact, everybody I know, every new election has been the most important election of their lifetime. So this was just as important. And the answer is I'm going to go through what we expect to happen, what we think might happen, and what changes we're going to make as a result of the election results. So first and foremost, let's talk about the economy. In the most, the campaigns are campaigns. They make a lot of promises. Bush was going to privatize Social Security. Barack Obama was going to drive us over the fiscal cliff. And Joe Biden promised us 43.4% capital gains taxes. I mean, he's only got a couple months left, and I don't think he's going to get it done. They make a lot of promises during this period. And in the most cartoonish sort of, vilification you could possibly imagine, Republicans would tell you that when Democrats get elected, we're going to become a socialist hellscape. And if Democrats say Republicans get elected, we're going to become a corporate dystopia that we'll never be able to recover from. The answer is, if you look at this chart, the one in the center here, this is a chart of consumption, business investment, and government spending. If you go all the way back to the 50s, consumers were a little over 60%. Now they're closer to 70, a little under 70% of GDP. Business is about the same as it was, and governments have dropped from a little over 20 to a little under 20. Can you picture a less dynamic chart with how many different presidencies we've had? Can you picture a less interesting move back and forth? This isn't a giant pendulum that swings all the way across. There are minor changes that happen over time. And the economy doesn't get completely rewritten the day of inauguration. That's not how this country works. So yes, although it's the most important election of my lifetime, and elections do matter, ultimately to GDP, I don't think people don't go on vacation or don't buy cars or don't go out and do fun things or don't create new products because they don't like the person in charge. It's just not typical. Speaking of the person in charge, I know the next question I usually get is, okay, well, maybe the economy has changed, but the market knows. And the market has favorites. The market always likes X type of administration better. Well, if you only invested $1,000 when Republicans were in office, or excuse me, if you invested $1,000 in 1953 and only had it in when Republicans were in the White House, you 27 times your money. Great returns. If you only did it when Democrats were in office, 52 times your money. Pretty impressive. However, if you put that $1,000 in and you accidentally forgot about it and didn't play this game, you'd have 1.4 million or 1,430 times. It's not even close. I mean, this chart isn't even to scale. It'd be even bigger than this. It's not even close. Trying to pick whether or not the right candidate is in office is sort of a fool's game. It's very, very difficult. You're better off taking long-term bets on what you think the market's going to do. The underlying economy is going to adapt to it over time. So, of course, the next question I get is, well, yes, you're right. The S&P 500, I get it. But we all know with the policies, there's going to be some major changes. And that's where I'm going to bring in these charts. Even the obvious play isn't very obvious. When Trump got elected, it was a surprise. And he was the drill baby drill, let's burn coal baby burn president. And for the first 2 months in office, the market rallied hard and really took off in the energy sector. Things looked pretty good. But over the course of his administration, what outperformed? Alternative energy. Alternative energy did great. Oil and gas did actually pretty poorly over his administration. Then Joe Biden gets into office, right? Remember, he's the climate change president. He's going to help fix climate change. He's no more fracking on federal lands. We're going to stop these sorts of things. We become energy exporters under his administration. We're not dependent on foreign oil. We're selling our oil to foreigners, right? Russia turned off their gas station to Europe. We're sending them our excess oil. What did well under the Biden administration? Oil and gas. What didn't do well? Alternative energy. So even the obvious play, and by the way, both of these presidents had departments of energy. You think if there's one thing they get right, it's when they have a whole department focused on. And it didn't work. So even the obvious play isn't so obvious in retrospect. Maybe you want to make more calculated plays based on what you think the underlying economy would do rather than president's announced policies. Speaking of presidents, if this chart ever shows us anything, it's that we all have confirmation bias. People like to think when their person is in charge that things are better than they are. When George W. Bush was in office, far left side of the chart, Republicans thought the economy was fantastic and Democrats thought it was horrible. In 2008, 2009, we all agreed for about a day that it really was horrible. And then we spent the next 8 years during the Obama administration where Democrats kept thinking things got better and Republicans really didn't. And then almost overnight, Trump gets elected, everything's great for Republicans. And Democrats not nearly as thrilled. Things don't continue to improve. If anything, at the end, they get worse. Biden gets elected, it flip-flops basically overnight. They have the lines there of the election day, but if you look basically just to the next tick over, that's probably the inauguration day. That's actually when it flips. I mean, it's that close. But yeah, Democrats right now think Biden's been great, and Republicans don't. And the only thing I can tell you is on election day, when we know who the winner is, probably this will switch, to whoever's in power. That's going to be the person that's going to be on top. That's a confirmation bias. And remember that consumer index? This is based off that consumer index I showed earlier, that we are still relatively negative right now. It just means that we have rose-tinted glasses. We can't quite see what's there without looking at the person in charge. But even that, and this is the point I'm going to end on today, the most important election of our lives. Hating the government is not an investment philosophy. Hating the president is not an investment philosophy. And people care about elections. Markets really don't. And why don't markets? This is the Trump administration and the Biden administration, their performance. You look, the first year for both of them was pretty darn good. And we forget now, we had a long bear market under Biden, but we forget, Trump, 17 was great. 18, 19 were really pretty sideways. We had COVID at the end and then a quick recovery. But it's really going to be funny here. This is from election day to election day. We're a month out. And the market returns have been within a statistical margin of error the same. It's almost identical. So if you think about that logically, that doesn't seem to hold true with anything that most people think. The market really isn't that concerned about who's president. So with that, I want to leave people with that presentation. A couple of different things to talk about. I want to take questions. I'll put that back up on the chart. Remember, the Fed is lowering rates. That is a sign that we're expecting slower GDP growth in the future, and we expect to go from 2.5 to like 1.8 next year. That's what the Fed's expecting. With that, rates might have already made their big move on the long end, and we're expecting them to come down on the short end. So if you got a bunch of 5% CDs, you're probably not going to get to renew those for 5% here in very long. Additionally, what's the market going to do? We are still worried about the overconcentration risk, and now the regulators and the IRS is worried about the concentration risk. When they get involved, that's a very important point. But even as they're finally getting involved, the rest of the market, the other 490 stocks, look even better than ever. The idea that we're expecting 16.7% earnings per share growth in the S&P 500, and we expect the majority of it to come from those other companies, is very important. And it's why we're seeing new all-time highs on the S&P equal weight. And lastly, elections. Hating the government is not an investment philosophy. Are there going to be some changes made to the portfolio around the election? Ultimately, probably not. Not nearly as many as people think. When Trump got in, it was a surprise. We were very excited about 2017 from a market standpoint when we thought Hillary was going to be elected. When Trump got elected, it didn't really change our outlook. And even the promises they make, we're going to not renew these tax cuts. We're not going to do this. We're going to change these. They don't always come to fruition. Barack Obama said we're not going to renew the Bush tax cuts, and they did. It's still hard to look your constituents in the eye and raise their taxes. Right? It's still hard to do. You still can't talk about Social Security without addressing it as people born in 2050 will have their benefits cut. People who aren't alive yet might potentially have and even that's too soon. So from our standpoint, when you're going to bet on huge policy changes, huge economic changes from a political standpoint, if you bet on no change, you're right more often than you're wrong. So with that, do we have a couple of questions that have come in?
We do have a couple of questions.
Great.
So a viewer asks, what's the dock worker strike mean for the economy and the markets?
Yeah, the dock worker strike's pretty fresh. They want like a 77% increase in their wages, which feels like a lot. The White House has, I think, asked for like a 50% raise. The White House does have the ability to stop the strike for 80 days. They could do that. I'm not sure exactly what they'll do. We know air freight rates have gone way up. I was talking to somebody about that today. You can't just move these ships. When you're driving a ship in, they've got only enough fuel. They can't just go through Panama or go around South America and go to the western ports. So this is going to stop the eastern ports. How long does this last? It's anybody's guess. It's under everybody's best interest to get this resolved as quickly as possible. We know the administration, the White House, is going to put a lot of pressure on it to get done. And talking about politics, Biden wants to be seen as a pro-union president, in our opinion. But at the same time, he really doesn't want people to be scrambling for goods on their way to the ballot box. So it is a very difficult situation that, as I said, everybody's encouraged to get this resolved very quickly.
Excellent. I think we have time to cover one more question.
Okay.
Should we be raising cash while the war in the Middle East plays out?
No. We all remember October 7th when Hamas attacked Israel last year. That's the problem. It's last year. Even Ukraine. I remember when Ukraine got invaded. People said we got to buy oil. It's $90 today. It's going to be 300 because Russia's gas station is going to turn off. 73 bucks a barrel today, and we're getting a little bit of a spike because of some unrest in the Middle East. But we're energy exporters now as the United States economy. We're sending our excess overseas. So are we extremely worried about this? And in the short term, always. In the long term, to some extent, it becomes sort of the normal piece of it. Part of the reason I think the market underreacted to the news that Iran was sending missiles into Israel is because it's kind of been growing tensions for almost a year now. A year is a long time. This isn't a new surprise, as much as it sort of seems like it is. It's part of the overgrowing tensions, and the death and the destruction cannot be understated. It's a horrible humanitarian crisis. But from a market standpoint, that's where I'm always looking at this from: is the market really going to be this concerned about it 6, 9, 12 months from now, or a year, 2 years from now? And I think the war in Ukraine would show us that from a market standpoint, Russia rewrote their nuclear doctrine and basically said people who supply Ukraine are subject to nuclear strikes. They blew up a missile inside of one of their silos trying to do nuclear testing. Market's not reacting to that news, right? Why? Because the Ukraine invasion's a couple years old, and it's terrible to think about it like that. That's how the market's reacting. It's underreacting, mostly because it doesn't seem like it's new news. So Is there unrest in the Middle East? Of course. The Houthis have basically shut down, trade around their controlled area there. But these are old stories now. It's amazing how old these stories get and how quickly they get old. So no, I would not suggest making huge wholesale changes to people's accounts or raising cash based on that economic news. Any other questions? Those are good ones.
Follow-up ones we can do for the sake of time. I think we're going to wrap it up for today.
Okay. All right. Well, thank you again, everybody, for joining me today. I hope this presentation was helpful. If you do have further questions, obviously we'll be back next week. Actually, I won't be here next week, but we'll make sure to answer them. Thanks, everybody. Much appreciated.